This video will cover what I call the new standard model for Bitcoin. And what do I mean by standard model? Well, I think we're in a position right now where a number of us quants, and I will throw myself in that mix, but I would completely single out Giovanni, Stephen Perrinode, Plan C, Cena, we've all kind of coalesced around this model, which is a model that incorporates the power law, which incorporates liquidity as a driver of price, which includes halving cycles as a determinant of price, and which has a model of volatility, a model of adoption, a model of how this thing could evolve into an S-curve via a Weibull function.
Fred Krueger starts by introducing what he terms as the new standard model for Bitcoin. Just as particle physics has a standard model to explain subatomic particles and forces, Bitcoin now has a comprehensive model that explains its price behavior and growth. This model encompasses several factors: liquidity, power law dynamics, halving cycles, volatility, and adoption curves, each playing a crucial role in understanding how Bitcoin evolves. The most immediate driver of Bitcoin's price, according to Krueger, is liquidity. Liquidity, in this context, refers to the overall money supply, such as M2, the money supply measure used in the US. But what makes liquidity critical? The fact that when liquidity increases, so does the price of assets like Bitcoin, but at an amplified rate. Krueger notes that when liquidity increases by 10%, gold typically increases by the same percentage, but Bitcoin surges by 40%. This hypersensitivity to liquidity highlights why tightening or expanding monetary policy by central banks, especially the Federal Reserve, has such profound effects on Bitcoin's price.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
And I really think that this is a very cohesive model now that we're starting to get to. And I really feel like it's not a stretch to call this thing the standard model, in the same sense as we have a standard model now for particle physics. Let's talk about the standard model, and let's start with liquidity, right? Because the most, in a day-to-day basis, I think the thing that could drive the most price is liquidity. And what do I mean by liquidity? Well, broadly, I mean money supply, M2, right? And I think, there's a lot of things that are creating liquidity. M2 is a good basis for it, US M2, but, there's been different ways of measuring global liquidity. Really, because of all this money printing, we're now, the main thing is refinancing the debt, right? Because the debt has become such a huge number that the cycles all revolve around refinancing the debt. And these tend to be actually measured as 60-month or 5-year cycles. And where the 5-year number comes is that the average maturity of the debt is about 5 years. We've got this 5-year phase to roll over the world debt. And of course, the U.S. is, at the forefront of that with, $30 trillion in debt. That is being issued at different maturities. Now it's being issued really at the short end, but it has an average maturity of 5 years. And as Michael said, the real goal of the real mandate of the Federal Reserve is not to cut on inflation, protect against inflation, or to protect against unemployment. The real mandate of the Fed, the unspoken real mandate of the Fed, is to make sure that the bond market operates and that the Fed, the U.S. government can tap the bond market for its issuance, right? So anyways, that's the liquidity side of it. Now, as Howell notes, and in his studies, if you increase the liquidity by 10%, the gold will go up 10%, but Bitcoin will go up 40%. So Bitcoin reacts is extremely sensitive to liquidity. And we saw that there was a fall in liquidity, about a 20% fall, a 10% fall in liquidity from 2022 to 2024. And, the first phase of that caused a real drop in Bitcoin in 2022. And so, that was probably more liquidity driven than halving driven. It was really driven by the liquidity, the Federal Reserve tightening interest rates.
Krueger discusses Bitcoin's halving cycles, which occur roughly every 4 years and have historically led to price booms. While these events were hugely significant in Bitcoin's earlier years, dramatically reducing the number of new Bitcoin mined and causing supply shocks, their relevance today is diminishing. With 95% of all Bitcoin already mined, the future halving events will have less impact on Bitcoin's supply and thus on its price. Krueger illustrates this by pointing out the relatively small number of Bitcoin being mined daily, around 450 per day, compared to the massive institutional demand, such as BlackRock recently purchasing 20,400 Bitcoin in one day. This demonstrates that future halvings will not significantly alter the overall supply-demand dynamic. However, this doesn't mean price won't be affected by other factors, like liquidity shocks. As Krueger predicts, the next major price move will likely coincide with global liquidity cycles rather than halving cycles.
And Marty always said, don't fight the Fed. That was one of his rules. And in the same sense, Bitcoin, you don't want to fight the Fed. So now we have the Fed on our side. We have money printing. We know that as the Fed's pushing, right, Bitcoin's going 4x on that. So that's the liquidity side. Now we have the power law side, completely separate. The power law is really much more of a story of adoption. So we have this new technology, Bitcoin, which is about 1% global adoption right now. So 1% of the world uses Bitcoin as kind of their main savings vehicle right now. I'm one of them. I hope you are as well. If you have been using Bitcoin as your savings vehicle, you've been doing very well recently. So that 1% is growing, right, by roughly the time since the Bitcoin was invented in the Genesis block in 2009 till now, right? So it's been growing for 15 years. And the power law says that as it's growing, as that time since the Genesis block has happened, it's growing at roughly 5.7 power of that time, right? So it's growing at a very high rate, at a rate that is faster than an exponential rate of money supply growth. So money supply growth is growing at 10%. Bitcoin's growing at currently at about 45% compounded annual growth rate, right? So 4 times faster than the money supply is growing. And it's growing that way because adoption is growing, and we're having adoption into this finite resource, and because according to Metcalfe's law, it's becoming more useful. There's more people buying into this new money paradigm. And the result of all this is that we have this very, very high growth in Bitcoin price, but it's a high growth with high volatility, right? Now, really hard to understand, to see any rhyme or reason in this volatility when you look at it in just regular space, or only if you look at the price in log space. You really need to look at the price and time since Genesis block in log space, so log space. And then you can measure volatility and you see it's 0.3 which is actually very high, but not so high in log space, right? So, and it's actually dampening a little bit. So, we have this very good model now for Bitcoin prices, and let's just call it a historical model, right? We don't need to say it's a predictive model, but we know it's a historical model. The fit is excellent. You can't argue with this. Now, if you try to fit an exponential model to it, you will find the fit is not good. So this model fits the power law. It does not fit the exponential. The data does not fit the exponential, an exponential hypothesis. Actually, at this point, the data does not fit Plan B's model at all. So Plan B's system is invalidated by the data. And I really think we should just drop Plan B, because Plan B was an early model, and a lot of people sort of perceived it as the standard model. They didn't think of it enough. They didn't analyze it enough. And I now think we can discard that model. And we really have this power law model, which is the genesis of a really great model. Now, so if you add in the liquidity model and the power law model, and then we also take into account sort of historically the halving cycle, right, which was very significant in the first two bull markets of Bitcoin, right? In 2013, when the market, when the halving happened, and these halvings were very, very significant. They made an enormous amount of difference in terms of supply. Today, not so much, right? We've mined 95% of all Bitcoin, and the halvings will matter for the miners, but they won't matter so much for Bitcoin holders, because, you know, we're mining right now 450 Bitcoin a day. BlackRock just bought 2,400 Bitcoin. BlackRock and Fidelity and the other ETF provider, but they bought 2,400 Bitcoin yesterday, right? So between Michael Saylor, the ETFs, this is not a question of who's going to buy this extra mining supply. That it's just no longer relevant, and that's just a bad model to have in your head, that there's this finite little amount of new Bitcoin that is, and you know, if that thing drops, it's going to make an enormous difference. It really won't, because if we're mining 450 Bitcoin a day right now, if we drop to 225, which we will next halving, it's not going to make that much difference. Those 200 Bitcoin a day are not going to make a world mountain of difference. So there will not be a supply shock. But there may be a liquidity shock worldwide, and there probably will be in 5 years, because we'll probably go through another liquidity cycle, because we always tend to do that. And so, you know, I think liquidity cycles will continue. Now, what does the power law predict? Well, power law predicts that 10 years from now, more or less, we should hit around 1 million in terms of Bitcoin price. Now, we could hit 3 million, right? We could undershoot it by only going to 500,000, but it's very unlikely that 10 years from now we're going to be at 100,000 Bitcoin. It's also pretty unlikely that we're going to be at 10 million Bitcoin. So gives us a good range of Bitcoin.
The new standard model for Bitcoin offers a sophisticated and cohesive framework for understanding Bitcoin's price movements, one that incorporates liquidity, the power law of adoption, halving cycles, and volatility. This model, supported by real-world data and the collective analysis of leading quants, gives us a clearer picture of where Bitcoin is headed. If you're interested in Bitcoin's long-term potential, this new model provides the most reliable lens through which to view its price behavior. Stay informed, don't fight the Fed, and keep an eye on liquidity cycles. The future of Bitcoin is bright, and with this model, you can better navigate the evolving landscape of cryptocurrency.
Thanks for watching. If you enjoyed this video, don't forget to like, share, and subscribe for more insights on investment strategies and financial tips. Leave your questions in comments below. I'd love to hear from you. See you in the next video.